Throughout history, societies have faced periods of economic crisis that transformed their structures and shaped their futures. A striking example is the Bronze Age recession in Britain around 800 BCE, when the collapse in the value of bronze triggered social and economic instability, forcing a transition to the use of iron. Today, recessions continue to challenge global economies, with complex causes ranging from external shocks like pandemics and wars to financial imbalances and policy decisions. Drawing on recent research from sources like J.P. Morgan and the IMF, let's explore what triggers these crises, their consequences, and how modern examples, such as the 2020 recession and the projected risks for 2025, help us understand and address these phenomena. For thousands of years, the people of Britain relied on bronze to craft tools, ornaments, and even as a medium of exchange and trade. Around 800 BCE, however, this began to shift. The value of bronze plummeted, sparking social unrest and an economic crisis, a phenomenon we would now call a recession. This historical event, often referred to as the Bronze Age collapse in the region, was marked by a scarcity of artifacts and a likely disruption in trade networks, possibly worsened by climate changes and economic strain, leading to a prehistoric gap that lasted centuries before the adoption of iron. Recent archaeological studies, such as those conducted by Cardiff University in 2021, highlight how British communities responded to these crises with increased mobility and collective feasting practices to maintain social resilience, showing that even in ancient times, economies could falter due to imbalances in critical resources. But what truly causes recessions? This question has fueled heated debates among economists for centuries, and for good reason. Their impacts can vary widely. A recession might be a mild dip in a single country's economic activity lasting a few months, or a prolonged downturn with global repercussions stretching across years, affecting jobs, investments, and overall well-being. Complicating matters, countless factors influence an economy's health, making it challenging to pinpoint precise triggers. To understand, it's helpful to start with the big picture. Recessions arise when there's a negative disruption in the balance between supply and demand. There's a mismatch between what people want to buy, what producers can provide, and the prices charged, resulting in a widespread economic contraction. This balance is reflected in key indicators like inflation and interest rates, which act as thermometers for a nation's financial health. Inflation occurs when prices for goods and services rise, effectively reducing the purchasing power of money. However, low and controlled inflation can actually stimulate growth by encouraging spending and investment. Conversely, high inflation without corresponding demand can erode wages and create instability, paving the way for a recession. Recent studies, such as those from the Federal Reserve Bank of Kansas City, indicate that interest rate changes have more volatile effects in high inflation environments, delaying economic recovery and increasing uncertainty. Interest rates, meanwhile, represent the cost of borrowing for individuals and businesses, typically calculated as an annual percentage of a loan paid to creditors until it's fully repaid. Low rates allow companies to borrow affordably, funding expansions and innovative projects that drive progress. High rates, however, raise costs for everyone, slowing consumption and production and potentially leading to a downturn. Fluctuations in these indicators provide clues about an economy's state, but what sparks these changes in the first place? The most obvious triggers are shocks like natural disasters, wars, or geopolitical tensions. For instance, an earthquake can devastate infrastructure critical for extracting commodities like oil, raising prices for oil-based products and discouraging demand, which can precipitate a recession. Similarly, wars disrupt global supply chains, as seen in the 2022 Ukraine invasion, which drove spikes in global energy and food prices. A striking modern example is the 2020 global recession triggered by the COVID-19 pandemic, which forced lockdowns and halted entire industries like tourism and manufacturing, resulting in an unprecedented economic contraction since the Great Depression. According to the U.S. Congress, this crisis underscored how public health shocks can amplify pre-existing imbalances, with global GDP dropping by up to 3.4% that year. Yet, some recessions emerge during times of apparent prosperity, perhaps even fueled by excessive optimism. Economists argue that market expansions can reach unsustainable levels, where businesses and consumers take on excessive debt, banking on continued growth that fails to materialize. If the economy slows unexpectedly, these debtors struggle to meet obligations, diverting resources from other areas and reducing overall activity. This was evident in the 2008 to 2009 financial crisis, known as the Great Recession, caused by a U.S. housing bubble where inflated home prices and risky subprime loans led to a cascade of bank failures and a 57% drop in the S&P 500. More recently, J.P. Morgan analyses suggest that poorly timed fiscal policies and financial crises remain common recession triggers in the U.S. Psychology also plays a critical role. Fear of a recession can become a self-fulfilling prophecy if it leads people to cut back on spending and investment out of caution. In response, companies reduce operating costs to brace for lower demand, which can include layoffs and wage cuts, fueling a vicious cycle that deepens the downturn. Research from the Brookings Institution emphasizes how inflation expectations shape behavior, and when nominal rates are low, central banks have less room to combat recessions, amplifying collective panic. In 2025, with U.S. recession risks estimated at 40% by J.P. Morgan Research and up to 93% by UBS due to inverted yield curves and credit pressures, fears of trade tariffs and restrictive immigration policies could heighten these psychological effects. Even policies designed to prevent recessions can contribute to them. During tough times, governments and central banks may print money, boost public spending, or lower interest rates to stimulate the economy. Private banks follow suit, making credit cheaper to encourage consumption. However, these measures aren't sustainable long-term, as they can lead to runaway inflation, requiring reversals that, if abrupt, cause contractions. For example, after massive stimulus during the pandemic, the U.S. Federal Reserve raised rates to combat inflation that hit 9% in 2022, which, per Rosenberg Research, increased recession risks by making borrowing costlier and slowing growth. Reports from the IMF and Yale University's Budget Lab warn that rising federal deficits heighten inflationary risks in both the short and long term, particularly in high-debt environments. The Bronze Age recession in Britain eventually ended with the adoption of iron, which revolutionized agriculture and food production, enabling a gradual recovery. In today's interconnected economies, navigating recessions is far more complex, requiring global coordination and real-time data. Each episode offers valuable lessons. The 2020 recession highlighted the importance of resilient supply chains, while 2025 projections from Deloitte and EY suggest that bond market turbulence and austere fiscal policies could trigger a downturn by the fourth quarter, with probabilities ranging from 35% to 60% depending on the scenario. Additionally, factors like trade tariffs imposed in 2025 could raise inflation and spark a recession, as cautioned by U.S. News and PIMCO, emphasizing the need to monitor indicators like unemployment, which edged up to 4.1% in February 2025, and GDP growth projected at just 1.25% by Goldman Sachs. To mitigate risks, economists recommend diversifying investments and building emergency reserves, especially in vulnerable sectors like housing and finance. McKinsey research notes that market imbalances, including economic cycles and geopolitical forces, remain primary culprits, but with better data from sources like the NBER, responses can be more agile, helping to predict and soften future crises. Understanding recessions is not just an academic exercise, but a vital tool for navigating today's volatile economic landscape, where events like pandemics, wars, and monetary policies shape the future of entire nations.